This is the moment you will remember for the rest of your life. This is the instant when the paper facade finally crumbled and the physical reality underneath exploded into view. I need you to understand what you are witnessing right now. I need you to grasp that we are standing at the edge of a financial rupture that will redefine wealth, power, and survival for the next generation. It is Saturday, January 24th, 2026, and the lies that have held the precious metals market captive for 40 years just detonated in front of the entire world. The fortress has fallen. The $100 threshold in silver is destroyed. We watched the metal surge past $100, hit $103.30 on Friday, and as of this morning, January 24th, silver is trading at $105 per ounce. For decades, they constructed a ceiling, they defended it with paper contracts, they defended it with media narratives, they defended it with algorithmic suppression and coordinated short attacks. They tried to convince you that silver was just another commodity, just another industrial metal, nothing special, nothing to fear. And now that ceiling does not exist, it has been obliterated. The price smashed through $100 like it was tissue paper, and the banks, the ones who have manipulated this market since the Reagan administration, are staring at their screens in absolute paralysis because they know what comes next. At $105, their problem is not a trading loss. It is not a quarterly write-down. It is existential insolvency. It is the moment when the liabilities exceed the assets and the phones start ringing and the lawyers start drafting and the executives start looking for the exits. Their entire operation is unraveling in real time. But if you think $105 is the story, you are looking at the wrong screen. You are watching the reflection, not the source. The source is not in New York. The source is not in London. The source is in Shanghai. While the West nervously crept past 100, China kicked the door off the hinges and sprinted into the triple digits weeks ago. We have the data from the Shanghai Gold Exchange, and it is seismic. Silver in Shanghai is trading at a sustained premium of $8 to $10 above the COMEX futures price. Let me say that again. The same ounce of silver, the same 47 protons, the same chemical element is worth $8 to $10 more in China than it is in the United States. That is not a fluctuation. That is not noise. That is a screaming, flashing, undeniable signal that the Western paper price is a lie. It is a fiction. It is a number on a screen that has no connection to the physical metal. In a rational market, a price gap like that lasts for seconds. High-frequency algorithms buy the cheap and sell the expensive until the spread collapses. But this gap has been open for days. It is widening. This tells us that the bridge between East and West is broken. It tells us that physical silver cannot flow fast enough to satisfy Chinese demand. And more importantly, it tells us that every refinery, every mining company, every vault operator in the world is looking at these two prices and making a decision. Do I sell my silver to New York for 105? Or do I sell it to Shanghai for 115? The answer is obvious. The metal flows east. The metal flows to the highest bidder, and New York is being drained dry. This is why the short sellers are doomed. They are trying to cover their positions in a market that is being vacuumed clean by a buyer who is willing to pay more. They are trying to fight an arbitrage that they cannot win. The US paper price is living on borrowed time. It cannot stay at 105 while the real world pays 115. It has to jump. We are approaching a morning, very soon, when you will wake up and check the price and discover that silver did not trade at 106 or 107. You will discover that it gapped to 115. Overnight, it will simply skip the numbers in between. It will teleport to meet the Shanghai price because the sellers will refuse to sell for anything less. This is the definition of a supply strike. Why would anyone in their right mind sell silver in America today when they can ship it to China and collect an instant 10% premium? It is financial insanity to sell in the West. If you own silver, you are holding the only exit ticket out of a burning building. The Shanghai price is the glowing exit sign. The US price is just the smoke filling the room. So why is this happening now? Why did the dam break this week? Because the market finally realized that the physical shortage is real. Let me walk you through what happened in the 7 days that changed everything. Between early January and mid-January of 2026, the COMEX, the Commodities Exchange in New York, lost 33.45 million ounces of registered silver in just 7 days. That represents 26% of their entire deliverable inventory, gone, withdrawn, delivered, in 1 week. Do you understand what that means? It means that the people who had contracts for silver stopped believing that the exchange would deliver. They stopped trusting the system. They demanded physical metal immediately, and they pulled it out of the vaults and took it into their own custody, and the COMEX had no choice but to let it go. This is not normal behavior. In a healthy market, traders are happy to roll their contracts forward. They are happy to wait. They trust that the metal will be there when they need it. But in January of 2026, that trust evaporated. Traders started paying enormous premiums to take delivery early. They started paying 8% annualized lease rates just to borrow silver to ensure they could meet their obligations. 8%, that is the cost of pure panic. That is the cost of a market that knows it is short and cannot hide it anymore. Let me put that in perspective. Under normal conditions, silver lease rates are near zero. Sometimes they are negative, meaning you get paid to hold the metal, but 8%. That is the market screaming that there is not enough silver to go around. That is the market admitting that the paper promises exceed the physical supply by an order of magnitude. And when those lease rates hit 8%, every sophisticated player in the world knows exactly what it means. It means the exchange is on the edge of default. It means that the COMEX and the LBMA, the London Bullion Market Association, the two pillars of Western silver pricing, are running out of metal. And when they run out, they will do what they always do. They will settle in cash. They will write you a check instead of handing you a bar. And the moment they do that, their credibility as a price discovery mechanism dies. If you cannot deliver the metal, your price is not the real price. It is just a number, and the real price is being set somewhere else. It is being set in Shanghai. It is being set in Hong Kong. It is being set in the markets where physical demand is. Real and paper promises are not accepted. This is the beginning of a tectonic shift. The center of gravity for precious metals pricing is moving east, and the West is being left behind with nothing but IOUs and empty vaults. But there is another force at work here that most people are missing. There is a reason why China is paying a premium. There is a reason why physical silver is disappearing. And it is not just investment demand. It is strategic policy. On January 1st, 2026, China implemented the most aggressive precious metals export controls in modern history. Beijing reclassified silver from an ordinary commodity to a strategic resource subject to government licensing. Only 44 companies in the entire country received authorization to export silver in 2026 and 2027. 44. That means the Chinese government has installed gatekeepers over approximately 121 million ounces of annual refined silver exports. That represents 60–70% of the refined silver that moves across borders globally. Let me say that again. China just cut off 60–70% of the world's internationally tradable refined silver supply. This is not a trade dispute. This is not a tariff negotiation. This is economic warfare. China is hoarding silver the same way they hoarded rare earth elements. They are securing a strategic resource that is absolutely critical for every technology that defines the 21st century. Solar panels, electric vehicles, advanced semiconductors, 5 grams infrastructure, missiles, satellites, batteries. Every single piece of modern technology relies on silver, and China just locked up the majority of the global supply. This is why the Shanghai premium exists. This is why physical silver is trading $10 above paper. Because the paper market assumed that supply would always be available. It assumed that if the price went up, more metal would flow into the West, but that assumption is dead. The metal is not flowing. It is being held in China for domestic use. The global silver market has been transformed from an integrated system into a series of isolated regional silos, and the West is realizing, far too late, that it is in the silo with the least amount of metal. The visible inventories in Shanghai have collapsed to their lowest levels since 2016. The inventories in London are being drained. The inventories in Zurich are being drained, and the refineries cannot keep up. Why? Because there is a structural supply deficit that has been building for 5 consecutive years. From 2021 to 2025, the global silver market has run a cumulative deficit of 820 million ounces, that is nearly equivalent to an entire year of global mine production. Those missing ounces were papered over by drawing down above-ground stocks. They were covered by melting old bars. They were covered by recycling industrial scrap. But now in 2026, the deficit is accelerating. Analysts estimate that this year alone, the market will be short by 200 million ounces. And with China cutting exports, there is no way to plug the gap. This is not a temporary squeeze. This is a structural supply crisis, and it is going to get worse before it gets better. Now let us talk about the other story that nobody is connecting to: silver. Let us talk about the crisis in institutional trust that is feeding directly into this metals panic. On January 22, 2026, President Donald Trump filed a $5 billion lawsuit against JP Morgan Chase and its CEO, Jamie Dimon. The lawsuit alleges that the bank closed Trump's personal and business accounts in February of 2021 for political reasons. According to the complaint, JP Morgan gave Trump and his affiliated entities 60 days notice and then shut down their accounts without explanation. But it gets worse, the lawsuit claims. that JP Morgan, under Dimon's direction, placed Trump and his businesses on a blacklist, a list that is shared with other federally regulated banks, a list that identifies individuals and entities with a history of misconduct or non-compliance. Trump's legal team argues that he and his businesses have always complied with regulations and that the blacklist was politically motivated. Trump personally called Dimon about the closures. Dimon said he would follow up. He never did. Now JP Morgan denies the allegations. They say the account closures were not political. They say they were done in accordance with federal law and regulations. But here is the problem. Nobody believes them anymore. The public does not believe that banks are neutral arbiters. The public believes that banks are political actors. And whether you agree with Trump or not, whether you think the closures were justified or not, the lawsuit has ripped open a wound that has been festering for years. It has exposed the concept of debanking. It has put a name and a face on the fear that millions of people have, the fear that if you say the wrong thing, if you support the wrong candidate, if you hold the wrong political beliefs, the financial system will cut you off. You will lose access to your accounts. You will lose access to credit. You will lose access to the payment rails that make modern life possible. And when people lose trust in the banking system, when they believe that their accounts can be closed at any moment for reasons beyond their control, they do one thing. They move their wealth out of the banks. They move it into assets that cannot be confiscated. They move it into assets that do not require permission. They move it into gold. They move it into silver. This is why the Trump JP Morgan lawsuit is not just a political story. It is a precious metals story. It is a trust story. It is a story about the collapse of confidence in the institutions that have held the financial system together for a century, and that collapse is feeding directly into the demand for physical metal. But even that is not the full picture, because while silver is exploding, while gold is hitting record highs, something even stranger is happening. Something that should be impossible is occurring right now in the broader markets, and it is the most dangerous signal of all. Let us talk about gold. On January 24, 2026, gold is trading at $4,988 per ounce. It hit a new all-time record. It is knocking on the door of $5,000, and Goldman Sachs, one of the most powerful investment banks in the world, just raised its year-end 2026 price target to $5,400 per ounce. They raised it from $4,900. That is a 10% increase in their forecast. Why? Because they see something that most people do not. They see that the demand for gold is not coming from speculators. It is not coming from retail traders. It is coming from central banks. It is coming from sovereign wealth funds. It is coming from private sector institutions that are diversifying out of dollar-denominated assets and into physical metal as a hedge against global policy risk. Goldman Sachs expects central banks to buy an average of 60 tons of gold per month in 2026. 60 tons per month, that is 720 tons per year. And according to the World Gold Council, 95% of central banks surveyed say they plan to increase their gold reserves over the next 12 months. 95%. This is not a trade. This is a structural shift. For the first time in decades, the market value of gold held by foreign central banks has surpassed their holdings of U.S. Treasury bonds. Let me say that again. Central banks are holding more gold than U.S. debt. That has not happened in 50 years. This is a vote of no confidence in the dollar. This is a vote of no confidence in us fiscal policy. This is the world saying, we do not trust your currency anymore, so we are going back to the only money that has survived every empire, every war, every collapse. We are going back to gold and silver, as gold's little brother is coming along for the ride. But here is where it gets terrifying. Normally, when gold goes vertical, when safe haven demand explodes, the stock market crashes. Normally, investors sell their stocks to buy gold. It is a rotation from risk to safety. But today is different. Today, the S&P 500 is rising. Today, the Nasdaq is climbing. Today, gold is at a record high of nearly $5,000. Silver is at a record high of $105, and the stock market is partying right alongside them. This is impossible. This violates every rule of traditional market behavior. Risk assets and safe haven assets are not supposed to rise at the same time. Unless the rise is not real. Unless the dollar is collapsing so fast that everything looks like it is going up. We are witnessing the most dangerous economic phenomenon known to humanity. We are witnessing the early stages of a hyperinflationary melt-up. Historically, markets operate on a seesaw. On one side, you have risk, stocks, tech growth. These are the things you buy when the economy is strong and you feel confident. On the other side, you have safety, gold, silver, bonds. These are the things you buy when you are terrified, when the economy is collapsing and you just want to preserve wealth. When one side goes up, the other goes down. That is the rule. That is how the machine works. But today, the machine is broken. The seesaw has snapped in half. we are watching gold approach $5,000. We are watching silver smash through $105, and simultaneously, we are watching the stock market climb to record highs. If stocks are rising, it means people are optimistic, right? But if gold is rising to $5,000, it means people are terrified. Both cannot be true, unless neither is rising, unless the assets are standing still and the ground beneath them is sinking. This is what a currency collapse looks like. This is what the Austrian economist Ludwig von Mises called the crack-up boom. It is the moment when the public realizes that the currency itself, the dollar, is dying. And when the currency dies, it behaves like a falling elevator. Inside the elevator, it looks like the floor numbers are going up. Floor 10, floor 20, floor 50, floor 100. But you are not going up. The building is collapsing around. Stock prices are going up not because companies are earning more money, but because the dollar you use to measure their value is worth less every single day. Gold prices are going up because gold is the only constant in a world where everything else is variable. This is the true emergency. If this were a normal market, the spike in silver to $105 would trigger a massive sell-off in stocks. Margin calls would force hedge funds to dump their equity positions to cover their metals shorts, but that is not happening. Why? Because there is so much liquidity, so much freshly printed, worthless fiat currency sloshing around the system that it is lifting everything at once. It is a liquidity tsunami. The Federal Reserve has lost control. The government is running a $2 trillion deficit during peacetime. They are printing money just to pay the interest on the debt, and that money has to go somewhere. It is flowing into stocks. It is flowing into gold. It is flowing into silver. It is fleeing cash. The market is collectively screaming, "I do not care what I buy, just get me out of dollars." This everything rally is the hallmark of a currency in its terminal phase. We saw it in Weimar Germany in the 1920s. The stock market went to the moon in mark terms while people starved in the streets. We saw it in Zimbabwe. The stock market was the best performing market in the world in nominal terms right before the currency went to zero. And now we are seeing it in America. The rise in stocks is an illusion. It is a mirage. You are not getting wealthier if your stock portfolio goes up 10%, but the cost of food and fuel goes up 20%. You are losing purchasing power while feeling rich. That is the trap. That is the seduction of the crack-up boom. It makes you think you are winning right up until the moment you try to spend your money and realize it buys nothing. And the proof, the absolute smoking gun that this is a liquidity event and not a growth event, is what is happening to central bank credibility. The International Monetary Fund, the IMF, issued a warning in January of 2026. They stated that weakened credibility of central banks, including the US Federal Reserve, is resulting in higher inflation expectations and lower global demand for US assets. They warned that if central bank independence is compromised, inflation expectations will de-anchor. That means people will stop believing that inflation will come back down to 2%. They will start expecting higher inflation permanently. And when that happens, inflation becomes a self-fulfilling prophecy. Businesses raise prices because they expect costs to rise. Workers demand higher wages because they expect prices to rise. And the cycle accelerates. The Fed's own data shows that core inflation, which strips out food and energy, is still running at 2.8%, well above their 2% target. The 10-year Treasury yield is at 4.26%, signaling that the bond market does not believe the Fed will bring inflation down anytime soon. And yet the Fed is still talking about possibly cutting rates in 2026. This is madness. You cannot cut rates when inflation is above target. You cannot ease monetary policy when the currency is already losing value. But they are trapped. If they raise rates, they crash the stock market and trigger a debt crisis. If they cut rates, they accelerate inflation and destroy the currency. They have no good options. They have only bad options and worse options, and the market knows it. This is why gold is at $5,000. This is why silver is at $105. This is why central banks are buying 720 tons of gold per year. Because the smart money knows that the Fed has lost control. The smart money knows that the dollar is dying. And the smart money is moving into the only assets that cannot be printed. But here is the question that everyone is asking. If gold and silver are exploding, if there is so much fear and so much inflation, why is Bitcoin lagging? Why is the so-called digital gold underperforming? Bitcoin is down, it is flat, it is not participating in this rally the way people expected. And the answer tells you everything you need to know about the nature of this crisis. This is not a speculative mania. This is a physical panic. When the chips are down, when supply chains are breaking and currencies are burning, the market retreats to the most primal form of value. It retreats to atoms, not bits. You cannot build a solar panel with Bitcoin. You cannot put Bitcoin in a missile. You cannot use Bitcoin to conduct electricity in a battery. Bitcoin is digital energy, yes, but silver is physical necessity. And right now, necessity is winning. The market is choosing the tangible over the intangible. It is choosing 5,000 years of history over 15 years of code. This is not a criticism of Bitcoin. It is an observation about human psychology in a crisis. When people are truly afraid, they want something they can hold. They want something that exists outside the digital realm. They want something that does not require electricity or internet or a functioning banking system. They want metal. And that brings us to the final piece of the puzzle. The piece that ties everything together. The piece that explains why $105 is not the top, it is the floor. Let me show you the math. Silver in New York is trading at $105 per ounce. Silver in Shanghai is trading at $115 per ounce. That is a $10 spread in a functioning market. That spread cannot persist. Arbitrageurs will buy in New York and sell in Shanghai until the prices converge. But the spread is not closing, it is widening. Why? Because the physical metal cannot move, it is being blocked by export controls, it is being blocked by refining bottlenecks, it is being blocked by logistical collapse. On January 19, 2026, COMEX, the largest precious metals retailer in the United States, issued an emergency communication. The CEO Ken Lewis announced that effective immediately, COMEX is instituting a mandatory $500 minimum order. $500. They are rationing silver. Why? Because demand has exploded by 400% over a normal weekend, and their internal production capacity has collapsed by 50%. They are canceling pre-sales beyond 30 days because they cannot guarantee that inventory will be available. Let me say that again, the largest precious metals dealer in the United States cannot guarantee that they will have silver in stock 30 days from now. This is not a normal market condition. This is a supply emergency. Retail is being locked out. Small buyers are being told, if you want silver, you need to come with serious money because we do not have enough to go around. And if COMEX is rationing, if COMEX is being drained, if Shanghai is paying a premium, what do you think happens? Next. I will tell you what happens next. The price gaps up. It does not climb slowly. It does not inch higher day by day. It jumps. Overnight, you will wake up one morning in the next few weeks and check your phone and see that silver opened at $125. It will skip 110. It will skip 115. It will teleport to the clearing price, the price where sellers are actually willing to sell, and that price is being set in Shanghai. That price is being set by physical demand. That price is being set by the reality of supply and demand, not by the fiction of paper contracts. So here is the verdict. Here is what you need to understand. We have shown you the evidence. We have shown you the COMEX drain. We have shown you the Shanghai premium. We have shown you the China export controls. We have shown you the Trump JP Morgan lawsuit. We have shown you the central bank buying. We have shown you the Goldman Sachs forecast. We have shown you the inflation data. We have shown you the everything rally. And we have shown you the physical shortage. The picture is complete. The diagnosis is clear. This is not a bull market. This is a currency crisis. Silver is not going to $105 because industrial demand is up, although it is. Silver is going to $105 because the dollar is going to zero. Gold is not going to $5,000 because of jewelry demand. Gold is going to $5,000 because central banks no longer trust. The US government, the measuring stick is melting. The banks did not lose control of silver. They lost control of the dollar. They had to choose between crashing the stock market and destroying the currency. And looking at the S&P 500 rising alongside gold, we know exactly what they chose. They chose the printer. They chose to sacrifice your purchasing power to save Wall Street. $105 is not the ceiling anymore. It is the floor. It is the rearview mirror. Do not anchor your thinking to these numbers. Do not think, I will wait for a pullback. Do not think, I will sell at 110. If you sell at 110 for cash, you are trading a scarce, irreplaceable asset for a dying liability. You are jumping off the lifeboat and swimming back to the Titanic because the Titanic looks bigger. Size does not matter when the ship is sinking. The window to exchange paper for metal is closing. Not because dealers are shutting down, but because the price is moving faster than your bank transfer can clear, while you wait 3 days. For funds to settle, silver moves $15. While you debate the premium, Shanghai moves to 130. You are in a race against a printing press that can create trillions in a keystroke. You cannot win that race with cash. You can only win by holding assets that cannot be printed. We are witnessing the end of the fiat currency experiment. The 50-year lie, the lie that began in 1971 when Nixon closed the gold window, is dying in front of us. The volatility you see on your screen is not market noise. It is the death rattle of the old system. The rising stock market is the trap. It is the bait. The rising gold and silver are the escape hatch. Do not be confused by the noise. Do not let the green numbers on your brokerage account lull you into thinking everything is fine. Everything is not fine. The water is rising. The dam has broken. The central banks have chosen inflation over deflation. They have chosen to destroy the currency rather than let the debt collapse. And your only defense is to get out of their currency and into real assets. Get out of cash. Get out of bonds. Get out of anything that is a claim on future dollars. Get into things that are real, things that exist, things that cannot be printed or debased or confiscated with a keystroke. The barrier is gone. The $100 ceiling is shattered. The printer is running full speed, and Shanghai is setting the real price. Hold your metal. Do not sell. Do not trade it for paper, because the paper is burning. And when the smoke clears, the only people left standing will be the ones who held something real.